Hey, Ed, let's start early. I got a question about life insurance.
Okay.
How come I can't get any? I've been around a while and I can pass the EKG. Urine is a little bit difficult. I don't really do the urine thing, but how would I get a term policy, a universal policy, or what?
You know, I'm really good. I'm just not that good.
Oh,
They
darn.
they discriminate against puppets.
Oh, there's no like a special puppet policy, PP policy? I thought that was what PPLI was, puppet policy for life insurance.
It is. But it's only really meant for Sesame Street characters and other characters of the Children's Television Workshop. It's a
Oh
group.
man, bummer. Hey, Alan, get me on Sesame Street, will ya? Well, I can't get you on Sesame Street. You don't listen to instructions. All right, never mind. Okay, let's get this started. This is Alan Gassman. Sorry to disappoint you that the puppet won't be moderating. And I'm here with my friend and an important mentor, Ed Gordon. I met Ed Gordon last year at the Heckerling Institute. I wasn't sure if I should go Sunday or not. It starts on Monday, and I said to Marcia, I think I'll just go Sunday and see what happens. Maybe I'll meet somebody I know. So I saw Jonathan Gottman in the lobby at the World Marriott, and he introduced me to Ed, who just happened to be walking by, and Ed and I had dinner with some lovely friends of his. And oh my gosh, I learned more having dinner with Ed than I learned the first 2 days of Heckerling, Monday and Tuesday. And Ed, before we even get started, I just want to ask you, where did you get all this knowledge? Are you self-taught, or you listened well, or how did you become so knowledgeable?
Fake it.
Okay.
No, I have a great insecurity that I'm gonna walk into a room and somebody's gonna embarrass me in front of a prospect. I also started in the business at 21 years old, and I didn't have much credibility then. I had too much hair, my eyesight was good, and I didn't have hemorrhoids. Now I lost my hair, which I do have has gone gray. I wear glasses, and I have hemorrhoids, so I always have that kind of cringy look on my face, like I'm concerned about the person I'm talking to. So
Well,
I very early on would drag lawyers like Dick Covey, who in my world invented Gratz, and I dragged them around Manhattan. I would always seek out people that are the best at what they do. Some of them really weren't fun at parties, but they're really good at what they do. If I read an article on ESOPs, I called the guy who wrote ESOPs, the article, and I said, hey, teach me what you know, and I'll bring you in on cases because I have an ability of getting in front of people. And I just acted like a sponge. The insurance business does that to you when you don't get a salary and you have to understand something to be able to sell it and communicate to somebody. If you want to eat, you have to be good at selling it. It's not a product that's bought. It's a product that's sold.
right. People can be downright irresponsible when it comes to not having enough life insurance to feed their families if something happens to them, right? That's for sure.
Yeah. And that led us down the road of lots of other uses for these types of products because of their unique nature that aren't just there to solve an issue of liquidity at death. There's other uses of it. And what we're going to talk about today is the good, the bad, and the ugly, because over time, like the game of telephone, the story gets perverted as you go further and further down the line. So, and in 32 years of doing this, 33 years of doing this, we've never gotten anybody in trouble, made anybody famous, or did anything that ended up in unintended consequences. And there's just a lot of techniques out there that have been pushed to the edges where they, get on the radar of the IRS and, become abusive.
Right. Okay, so before we get started, let me do a little bit of housekeeping, and then I'm going to hand the control of the deck over to you. At noon, this presentation will end, but Jerry Hash and one of his star students is going to join us, and we're going to go over where we are with Estate View and give you sort of an instruction manual for Estate View. If you came in through CPA Academy, you need to answer 3 of the 4 polling questions. If you came in through our website, you don't have to answer any of the polling questions. You could just like pet your cat or train your dog or whatever you want to do during the polling questions. If you have a question, you can click on the inverted pyramid and then upside down, type in your question upside down, and then we'll answer it upside down. If we don't answer it during the presentation, we'll make sure we answer it afterwards. This will be posted on the Alan Gassman YouTube channel, probably around 4 o'clock this afternoon. So you'll be able to watch it there. If you're not able to, if you want to watch it again and again and again, which is what a lot of Ed's fans do. And then if you want a better picture when you watch the rerun, hit on settings, hit on HD, and you'll get a much better picture. We'll talk more about Estate View later, but this slide tells you how to get onto Estate View. You don't have to buy Estate View. It's just in the beta stage. You're welcome to go on there. And then I'm going to do the first polling question now. So Ed, we do 4 of these, and then they're all here in the beginning of the deck. So I'll be asking you to return here and do the next polling question eventually. But the first polling question is Ed Gordon, and the answer, by the way, is all of the above, F, which is probably what Ed's score in social studies was in middle school. But A, he's the founder of Preservation Capital Partners. B, he supports the New York Holocaust Museum and has been on the board. Number 3, he has supported the Guide Dog Foundation, has been on the board. D, he lives on Huntington Bay in Long Island. E, he's a certified estate planner. And F, all of the above. And if you answer F, you will be able to send any question you want to Ed anytime you want, and he might answer it. So Josh, how are we doing there? The poll is open, and your vote counts. All right. So Jerry Hesh is going to be with us at noon. We're going to talk about the Notre Dame Estate Planning Institute for a minute. So I just have the information there if you want to go ahead and sign up for it. And then Josh, I see, okay, there's question 2. So we'll be coming back to question 2. And then we have the cover slide. So do you want to take over the screen there, Ed? Put this on your screen so you can put your PowerPoint to the same page?
Sure. I don't know what screen I'm sharing at this point.
Well, I see the planet Earth. That's pretty cool.
That's the wrong screen I want to share.
I'm glad we're not seeing your home pictures.
Or my browsing history.
Your browsing history, right. You probably stopped sharing it, and then who knows what.
Yeah, why don't you share the deck then? Because I have so many screens on my computer, I don't know how to share it on this system.
Okay.
So you could share it. I'm going to briefly run through what's in the deck. It's a lot of pages, a lot of what I call tax porn, which is just citations of sections of the code and stuff like that, which maybe impress some people, but really doesn't make much of a difference. So I'm kind of going to get started a little bit. So as I said earlier, the insurance industry has some really interesting attributes on their products, and that leads to a number of abuses that happen in the industry. So if, Alan, would you think I should give a background on each type of insurance product quickly and then build from?
Yeah, 1 minute. I would.
All right, these aren't on the slide, so I can run through this. So I took a wine tasting class once, and the gentleman who taught the class taught it a very interesting way. He said, in front of you are 3 glasses of red wine. One is heavy cream, one is whole milk, and the other one is skim milk. Taste all 3 and put them in order. Obviously, the big chunky one was a big old Brunello. The medium one was a Cabernet, and the light one was a Pinot Noir. Don't ever make fun of Pinot Noirs, they're very thin-skinned. Life insurance is the same way. Your whole life is your heavy cream. Your regular universal life and your variable life are your whole milks. And your term insurance is your diet, your light one. Term insurance is exactly what it says. It's a life insurance policy that lasts for a period of time. If you don't die during the period of time, the policy typically ends or gets really crazy expensive. Sometimes they're convertible to permanent policies. Permanent policies are ones that are geared to last to maturity or past. And term insurance has no cash value element. Cash value of a life insurance policy is an overpayment of the cost of the premium. I'll say that again. Cash value is created as an overpayment of the cost of the contract. So if you took term insurance and you attached to it a bucket, and instead of paying the dollar that is the true cost of the insurance contract, and you paid $1.50, in theory, $1 goes out the door to pay for the cost of the death benefit, and 50 cents falls into the accumulation bucket, which we call cash value. Cash value grows entirely tax-free. In most cases, cash value can be borrowed out of an insurance policy, tax-free. And when the insured dies, all of the assets of the policy go to the beneficiaries, tax-free. And unlike an IRA or a Roth, a life insurance policy can be held outside of a taxable estate in a trust that Alan or Jerry would set up for you. Life insurance by its nature in most states is exempt from creditors, depending on how it's owned, especially if it's owned in a trust outside of your estate. It's clearly exempt from your creditors unless it's set up incorrectly. So when you have all of these attributes, you really create a really big benefit for clients. Most people don't understand or look at insurance from life insurance from that perspective. So let's go into some of the uses of it and some of the abuses of it. Number one, the IRS hates any technique that claims to create the tax deductibility of life insurance. If you have an asset that builds tax-free and pays out tax-free, I assure you the IRS does not like you trying to deduct the premium. If you deduct the premium of life insurance, the death benefit's going to be taxable. That's just the way it's going to be. I've seen lots of life insurance policies owned by companies as key man policies, and they deduct the premium every year. Well, there's not too much in the way of court decisions on it because nobody really sees it, but it is not legal. And you could look up in Tax Facts, which is my favorite reading book at night. But over the years, because the tax deductibility of life insurance and letting the money grow entirely tax-free is the holy grail of what insurance producers look for, there's been lots and lots of those techniques over the years, and most of them really don't work the way they're purported, or the IRS has shut them down. Years ago, there were plans called welfare benefit plans under Section 419A, 419AF6, and we looked into it at one time. And those were programs where the life insurance premium was deducted by the company under this plan. And the IRS in their ruling said that you could deduct the direct cost of funding. So I picked up the phone, pretended to be a law student at Hofstra University Law School, and I called the IRS and said, I'm a student, and what do you mean by the qualified direct cost of funding. The gentleman that I spoke to on the phone, I found because he runs the section of the code under 419. There's actually a phone book you could look at that shows you sections of the code and who handles it. And he said to me, we don't define that. I said, well, if I asked you in a ruling, in a private letter ruling request, would you answer me? He says, no, that's on the no rule list. I didn't even know what a no rule list was at the time. I thought it was interesting, but I figured that if the IRS was waiting to figure out what their definition of a qualified direct cost was, if I made up one, I'd be wrong. So we chose not to do that. And years later, the IRS came in and said that these were abusive plans and this wasn't tax deductible. And lots of insurance people got their clients very angry with them because they had to go fight this. And they didn't remember that they were told that this was a riskier transaction than just paying premium and with after-tax dollars, and and then they had to start all over again with a new client base. But it was easy to sell because people are greedy, and they always want to get an edge. When those rulings came out on 419, they were pretty broad, and there's a revenue ruling. I don't know. Maybe Jerry knows it off the top of his head, but I think it's 2007, 84 or 83, somewhere in there. It says that if you basically build a plan that has any elements defined in the broadest definition that look and smell like this, you have to report to us that you're involved in this transaction of interest. And there's lots and lots of things that I've seen over the years that clearly fall into that definition because they had elements of the 419 plans, but they were just called something else. One of them that's out there today, which I've looked at extensively, and I choose to take a conservative approach and not do it, is a plan called the Restricted Property Trust. And that kind of looks and smells and acts like 419. They did some creative things to the plan so that it kind of doesn't fall into it. There's been a couple of court cases on it, but those were not really about the plan itself. It was really about whether or not they should have reported as a listed transaction. And some of the promoters out there are saying that, the IRS said that it was okay because they went through these audits, but I will tell you that those audits were not directly at the plan. It was literally whether or not you needed to list this as a listed transaction or not. They also purport to have an IRS audit that was done, and it cleared the audit, but when I hired a lawyer to look at this information, it was really a field officer's report looking at the transaction saying it was okay. And basically a field auditor's report is worthless. It's not even admissible in court for you. So we chose to stay away from that. They're still doing them. They've been doing them for 10 years. If you look at the paperwork that the insurance broker has, that he has the client sign, it basically says that you're holding the insurance broker, the insurance company harmless, and that you relied on your own counsel and your attorneys to do this. And I got to tell you that that piece of paper on its own would keep most of my clients from ever getting involved in a transaction. So where, some insurance person makes a whole lot of money, and at the end of the day, you get your head handed to you by the service, and they just, throw this piece of paper back to you and say, well, it was just our idea and we implemented it for you, but you signed this piece of paper saying that you're holding us harmless. To me, is not a great way of doing business.
Well, I'll pipe in. I'll pipe in and say, and I've been doing this, I think 38 years now, that when somebody says, I have a friend from out of town, he has a very exclusive and powerful income tax planning technique, and it's almost December 31st, and all you have to do is give him a check, and you'll save a lot more money than the check that you write him. And someone who used to work for the IRS is involved, and they know it's okay, and there have been audits and the auditors have said it's okay. When you hear those things in concert, run away as fast as you can. A lot of times it involves life insurance because they don't have to take a check from you. You write a check to the carrier. The carrier has not approved the arrangement. The carrier writes a commission check to the salesperson, and everyone pretends they don't know about it. And then what the IRS does is they will get the client list of the promoter, and then they'll go audit the people on that client list, not only for this matter, but for everything they've done in the last 3 years. So it's usually not a pretty picture, and a lot of CPAs get caught up in it. So if you're a CPA and you haven't been through that experience, and you haven't been sued for malpractice, and you haven't sat through depositions and been asked by the IRS why you went along with this and signed the return, talk to someone who has before you go, oh, that's a great idea. He took me to dinner. He's so nice. He even has a jet airplane. This must all work fine.
Yeah.
And then
So, and a lot of other professionals that are not directly in the insurance business have gotten licensed over the years, like accounting firms. Some law firms have set up subsidiaries that are financial planning subsidiaries that are licensed. And I will tell you that in my experience, most of them don't do the research on what's being done. And they just set up those entities or getting licensed so they can share commissions with the insurance broker, who's the outside insurance broker. And, let's just say that sometimes the numbers are pretty compelling for someone to turn a blind eye to some of the glaring questions that should be asked when you have a 6-figure commission coming in and you have to pay your mortgage and your kid's wedding and whatever it is. So money does change people. I've seen it over the years, and I think that people have to do a little bit more due diligence on what's being sold to their clients. And, if it sounds too good to be true, it typically is, but not always. There are really good techniques out there that really work well. Let's talk about a couple of other techniques that are out there. They were programs called Section 79 plans. These were group policies that everybody in the company got, $50,000 of a term benefit, but yet the owner of the insurance company, rather the owner of the company, doesn't get the term benefit, but he gets a permanent benefit. And the IRS blew that apart as well. Again, there were a lot of promoters doing that. There were and still are techniques like a 831B captive insurance company. Those are or micro captives. I don't think that they're necessarily bad. I've implemented several over my career. I think they work well for clients. But because you're deducting the cost of funding of your insurance premium and putting it into your captive, that's great. Now the captive has the money, and the captive doesn't pay taxes on its premium income, but the captive insurance company does pay taxes on its investment return. So what do creative insurance people do? They say, well, your captive insurance company should own a large life insurance policy, and the premiums that you put into your captive for your property and casualty risk that are now sitting in this reserve bucket, rather than paying taxes on it, why don't you shove that into a whole life policy or a universal life policy or a variable policy where now it grows entirely tax-free? Although that is not explicit in the law that says you can't do that, I am telling you from conversations I've had with the IRS, you're dead. They do not like that whatsoever. They don't want to see it. They don't want to, and one of the things that you'll find if you ever get audited is the IRS not only asks for all of the materials that you have related to the transaction, they want to see all of the emails from the promoter, the lawyers, the accountants. They want to see not only what the plan is that you implemented, but more importantly, why you implemented it. And in conversations I've had with the service, the why is actually more important than what you did. So a captive property and casualty company is a great idea. You get to take premiums, deduct them from your company, have them sit in a captive insurance company. And those premiums can be used for liabilities that are organic to your business and have probability. If you're in New York City and you're solving for some tsunami risk, you're probably not going to get the deduction. But if the material, and then one day you decide that you liquidate your captive and you take all the money back as a qualified dividend, the liquidating dividend, so you took today's current taxable profits at income tax rates, shifted them into a vehicle where you deducted them, and then one day you distribute them as a dividend, I will tell you that I have seen marketing material that says that this is better than a defined benefit pension plan, because you could put substantially more money into your captive, discriminate against all of your employees because it's not a plan under ERISA, accumulate all of this money in this 831B captive bucket, and then the day you retire, you liquidate the captive insurance company and distribute a tax qualified liquidational dividend at a lower tax rate. Boy, that sounds sexy. And that's the way it was sold. And I assure you, if the IRS sees paperwork that says that you did this because you thought that this was a better alternative to a defined benefit pension plan that was discriminatory to all your employees with larger deductions and a better taxable event at the end, you're dead. And I've literally seen comparisons between defined benefit plans and 831B captives.
So be careful what you put in writing. Be mindful that the attorney-client privilege doesn't apply when you're copying people who are not part of the lawyer function. Let me just do a quick polling question, Ed. So this polling question is, would you like to beta test our Estate View software? A, yes, and I know how. B, yes, but I don't know how. C, please repeat the question. D, can I please sign up for a Spinal Tap instead? Wow, there's no all of the above. This is a challenging one. All right, Josh, are we at 3, 2, 1? Back. All right, Ed, what's next?
So just a couple of points. One, rumor has it that if cancer had a commission in it, some insurance guy would have figured out a plan to solve it already. I honestly will tell you that some of the most creative minds I've ever met in the tax business use life insurance and understand it, the product, and the lawyers and accountants that think it's some sort of game are just totally wrong. The really sharp people in the space understand the use and the utility of it in lots of different ways. And it's something that's, if it's not a part of a practice or a knowledge base of a practice, somebody should get in there and do it, because it is one of the most unique financial products in planning, bar none. The other thing I'll tell you, that if a life insurance illustration is presented to you, the only column you should ever read are the guaranteed columns, because the non-guaranteed columns only prove one thing, and that is that ink will stick to paper. In 32 years of doing this, I will tell you, I have, even on policies I've written myself and done my due diligence on, whatever happened when you wrote that policy and the way it was illustrated will never look the same 5 years out, 10 years out, or 20 years out. Most of these plans and these policies are built to last until the client dies. Unfortunately, the insurance broker typically gets paid a lot of money up front, After they sell the product, they tend to do a hit and run. If there's bad news, the policy goes sideways, the dividends didn't do what they were supposed to, the economics, whatever it is, I assure you that very difficult phone call to make to that client that they made money on years ago and really don't make any money with them currently, they tend to just not make the phone call. And it's usually some other professional that comes in the door that looks at it and cleans up the mess, and then, you know, the client's looking at them is no different than the guy who hit and run. So, and that's a lot. There's you know, we see that a lot. Anyway, going back to my list here, split dollar is a method of paying for life insurance. Split dollar is nothing more than an arrangement between a premium payor and the owner of an insurance policy. It's been used since the 1950s. It's been changed a little bit in the early 2000s. And basically it says that somebody's going to pay a life insurance premium on behalf of somebody else. The person who's benefiting from the insurance has to pick up a cost, whether it be done as a split dollar loan where interest is accruing, or it could be done under something called economic benefit, where the IRS says that since the trust, in this case, is enjoying the benefit of insurance that they didn't pay premium for, they have to pick up a small amount as taxable income each year. We used to call that the PS 58 cost. Now it's called the Table 2001 cost. Every major company in the world used to use split dollar for their executives. The company would outlay, you know, $1 million a year in premium for an executive. And the owner of the policy, the executive, would have to pay back the corporation upon the death of the insured, or if the policy was ever surrendered. That's a typical arrangement. And therefore, the difference between the premiums paid and the death benefit is what goes to the family entirely tax-free. In public companies, that became an issue for executives under Sarbanes-Oxley. It was considered to be an extension of credit to an executive or officer, and under Sarbanes-Oxley, you couldn't do that. But lots and lots of small privately held companies do this on a regular basis. There's even something called family split dollar, where senior generation outlays money to a trust. It's not considered a gift because it's considered either a split dollar loan or economic benefit. And again, what's includable in the estate is the receivable upon the death of the insured. We use split dollar a lot when we don't have the gifting ability to pay larger premiums. So large life insurance premiums of hundreds of thousands of dollars or even millions of dollars are typically done through large gifts initially, and then split dollar loans or economic benefit on a going forward basis. I'm going to bring up a subject that's not included here, but I'll give you a little special sauce that most people don't know about, or a lot of people don't know about. There was once a court case called Crummey versus Commissioner, and I'll summarize it in the simplest terms I can. And of course, Professor Hash is going to clean that up for me, I'm sure, in more technical terms, but I'll give you an example. If I make a gift to a trust of $25,000 and I have a couple of beneficiaries in there, that would normally, and they can't use that money today, that would be a gift of a future interest that comes off of my credit. To make it qualify as an annual gift, I give the beneficiaries of that trust a right to withdraw that money for a period of time. And if that period of time lapses, then the money is used for my life insurance premium, and it's considered to be an annual gift, not a lifetime gift. Alan, am I right about that?
You did great.
Great.
Fantastic.
So there was some really interesting court cases that came out and said, gee, how could you really push the envelope on this? And there's always someone that does, and a lot of people get caught up in it. And the concept of remote contingent beneficiaries came about. So let's say I only had one child and I was only able to give one gift a year to that child's trust, and my wife was able to give one gift a year to that trust. That really doesn't amount to a whole lot of money when you have, maybe a life insurance premium that's $250,000 a year, and I don't want to use up my exemption amount, or maybe I've already used my exemption amount for other things. So I put into the trust lots and lots and lots of other people, maybe my nieces, my nephews, my neighbors' kids, whatever. And I make them remote beneficiaries, meaning that my child is really the primary beneficiary, but all of these people could have an interest in this trust if whatever the remote terms you want to create. And I make a gift to this trust that's an annual gift for all of these people. And I give notice that everybody has the right to withdraw this money out if they wanted it for a period of time. We call it a Crummey letter, and the IRS, by the way, said Crummey letters don't have to be in writing. It just says notice. So take that to the bank if you want. And because I have all these remote contingent beneficiaries and they all had the right to withdraw during, let's say, 30 days, it all qualifies as annual exclusion gifts, even though most of these people really don't even know that they have these gifts available to them. Anyway, so there was a court case on this, and the taxpayer won, saying that these were all, and they had over 100 gifts that they were making a year. I've done a number of these trusts with remote contingent beneficiaries, and my clients don't like this, but one of the things I make them do is I make them draw a name out of a hat every year, and they must distribute out to at least one person the money they put in there. Because I think that if I stood on a stand and I put all of this money into a trust year by year by year, and nobody ever took out any money out of this trust when they had the right to, I don't think the optics of that are good. So people should take money out and exercise their withdrawal right. I think that optics are really important in tax planning, and it would be really difficult for the service to say that this was, a technical term, a bullshit transaction, because this was really for the benefit of the one child, and that these remote people weren't really ever going to get this money. So by having people take money out every year, I think you legitimize the transaction. So that's another way of getting large life insurance premiums or large gifts into a trust. You want to ask another polling question?
How did you know? So here's the polling question. Josh, are we on? All right. The answer is D as in dog. Arr, 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 arr. That was not a real dog, by the way, but if your dog barked, that's good. The Notre Dame Tax and Estate Planning Institute 49th annual, Jerry Hesch is the director, will be held September 20 to September 22 near and at Notre Dame University, South Bend, Indiana. Lots of airlines go there. It's a Wednesday afternoon through Friday. Can be attended live, or you can order the materials and videos. It's packed with content. C, there are tax superheroes there. And D, all of the above. No, they do not wear capes or actually fly yet. All right, Ed, let me just go over something on split dollar. So what Ed said was, when I set up an irrevocable life insurance trust, Marcia and I can donate $34,000 a year to that trust. We can give our daughter Nicole the right to withdraw what we put in there, or to withdraw the life insurance policy if we pay the premium directly. And then Nicole shouldn't withdraw it, or we'll disinherit her, and that qualifies as a gift to her. But if we were to make a $250,000 premium payment, what we will do is we'll advance the money to the life insurance trust, $250,000 a year, and on the death of whoever the insured is, we'll get our money back. And if we do a loan regime split dollar, we'll get our money back on the death at the applicable federal rate in effect at the time we put the 250 in. So this year, if we put the 250 in right now, it would be about 3.98%. And then in 20 years, when someone dies, then the loan gets repaid at 3.98%. If we do another 250 next year, again. But because Marsh and I are relatively young, we're both in our 60s. Well, Marsh is not, but I am. Don't go buy your driver's license. Anyway, we can use the economic benefit regime, and this imputed loan amount, I'll call it, is much lower until we reach our mid to late 70s. So that's why for a lot of clients, we say, you know, I'd rather see you do split dollar advances into that life insurance trust and use your Crummey withdrawal powers to make gifts of discounted non-voting member LLC interests. And when you run the numbers, the client comes out much better.
Agreed.
Alan, can you hear me?
I can, Jerry, and it's nice to hear you.
Yes. By the way, Ed, I am so pleased to hear someone talk about how the literalists put blinders on, just look at the literal language, and then say, we're going to ignore the principles behind the statute and just look at the literal language, and therefore this can work. I'm so glad that you're doing something like this.
Again, there's a concept that I learned a long time ago. In the law, you would call it the perception of impropriety. I learned in Hebrew school it was called marisayan. That's a Jewish law. Like, for instance, you can't eat a cheeseburger in public, even if the cheese is made out of soy and it's kosher. It's the perception that other people walking by would see it and not know, and therefore you shouldn't do it. So I think if you look at all of these techniques and you just take a quick glance, and if somebody really has to explain to you why it works, you probably shouldn't be doing it. That doesn't mean all the time that the person's wrong. It's just that at a high level, things should look naturally acceptable. And
I have another question. A lot of the snake oil, I shouldn't call them snake oil salesmen, but what they do is say, we have a tax opinion that we can give you written by a lawyer who's got an LLM in tax who you've never heard of. And basically they say, now that you have a tax opinion, you don't have to pay penalties. What do you think about that?
well, I will tell you that on a technique I'm not going to mention, I have read tax opinions that I don't think the court would recognize as being valid, because under Circular 230, they don't really hit all the points that a tax opinion should. However, I still do a lot of things where I do get tax opinions from lawyers just to make sure that, one, another set of eyes is looking at it who's considered an expert in the field and is willing to put their reputational risk on the line. And two, the opinion letter better be an opinion letter that hits all of the relevant points that the IRS wants to see when you're relying on it.
You made a very good point, because I read these tax opinions. Everything in the tax opinions is technically correct. The problem is they don't discuss the issues that have the flaws.
Right.
So therefore, those tax opinions aren't worth anything.
Correct. The other thing is that just because the tax opinion says one thing, the conduct of the parties tends to do something else anyway.
Oh,
So,
like Weber.
Correct. So, although there aren't a whole lot of cases you could point to where there was a tax opinion that penalties were assessed, but there are some pretty abusive situations out there. So I take that with a grain of salt. And even though I believe that a tax opinion or a tax memo from any financial professional that complies should be acceptable, I will tell you that when I do some of these things, there's a difference between getting a tax opinion from Shmuel Rabinowitz, attorney at law, and Baker McKenzie.
Very good. Go on.
And it's not just price.
Alan also made a very good point, and we're going to demonstrate this in estate view. The key is you want large life insurance premiums to be paid. You don't have enough gifting ability through Crummey powers or whatever, and the split dollar transaction is very good, but you don't have to limit yourself to split dollar transactions, because any established estate planning technique, and we're going to demonstrate this in estate view in the second hour, you do an installment sale to a grantor trust, you do a GRAT, and there's a spread, and several thousands or hundreds of thousands of dollars build up in extra cash each year after payment of the GRAT annuity or after the payment of the interest on the note. And that's funds that the trust has, and the trust can use those extra funds from what we call the financial leverage to pay the life insurance premiums.
Right. So I'm going to stick to split dollar for a second and give you an alternative use of split dollar, which I've used in the past, and it led down the road to something of another technique that's out there, albeit not perfect. So many years ago, I read a court case where a small company had split dollar plans with some of their executives as a benefit. So the corporation outlaid premium every year, and the corporation had the right to get back their premium plus interest upon the death of the insured, or if the owner of the policy surrendered the policy. So let me make that clear. The corporation outlaid money and was going to get it back when the employee died, or if the owner of the insurance contract ever surrendered the contract. The company went bankrupt, and the creditors came in, and the bankruptcy court sent a charging letter to the insurance company to surrender the insurance policy that was on an executive's life that was sitting on a lot of cash value. And that decision was appealed, and the appellate court rightfully said that the corporation's rights to that cash value were limited to when the employee dies, or if the trustee, in their sole discretion and best use for the beneficiaries, decided to surrender the contract, and that the corporation didn't have that right, nor did the creditor, and therefore the cash value of the insurance policy was not subject to the bankruptcy. Only the receivable that the corporation owned, which, let's face it, could sit there for 30 years before it ever paid off. So I walked into a situation of a school bus company that was sitting on millions and millions of dollars of retained earnings in a C corporation. And I said to the client, "Why do you have all this money there?" And of course he said, "Well, I don't want to issue a taxable dividend out of my company because I don't like paying taxes, and the money's just sitting there doing fine, and it looks really good." I said, "Great, you're a school bus company. And if a kid falls asleep on your bus, ends up in the depot overnight, or one of your bus drivers gets into an accident, I really don't care how much insurance you carry. If you're sitting on millions of dollars of cash, some lawyer is going to go after it, and you're going to lose it because it's cash." So what we did is the company entered into a split dollar agreement and paid $1 million a year for 5 years to a trust that insured the vice president of the company, who happened to have been the chairman's son, who was 40 years old. And the corporation had the right to get back its money plus interest upon the death of the insured, or if the policy was ever surrendered by the trustee. I believe that that puts a major hurdle in front of that $5 million. And if the company ever went bankrupt or was sued, the likelihood of them going after that money or negotiating to take a much smaller number to go away rather than waiting for the death of Junior to happen. It is a very interesting technique and use of split dollar in life insurance. You cannot do split dollar with anything else other than a life insurance policy. So we've utilized that technique many, many, many times. And then a more recent transaction came out that people were doing, although, well, I should say talked about, which is they did this in a family situation where mom and dad lent on a split dollar note tens of millions of dollars to a trust that insured the children's lives. And mom and dad took back a note that says that they could get paid back upon the death of the insured or if the policies were ever surrendered. And let's just say mom and dad passed away at some point in the near future. And now the estate is sitting on this receivable, which they can't collect and they can't force the trustee to surrender. So I'm going to give you a real example. We did this with a client with $83 million of premium over a 5-year period. We insured the children's lives and their spouses. There was no surviving spouse, so dad was a single widower at the time. Dad died. There was an $83 million receivable in his estate. We went out and had that valued by 3 valuation firms. The IRS rejected our value and said they would take $12 million as the value for estate tax purposes of that $83 million note. Since then, there have been 3 court cases, Levine, Morissette, and Cahill, all kind of different from each other. And there are people running around saying that the IRS or the tax court has blessed this technique called generation split dollar or discount split dollar, and it's been written about a lot. It does work to some degree, but again, like most things, people are out there selling it in a simplistic, uninformed way, thinking that it just works and not understanding the nuances. Again, I went to the horse's mouth recently. I went to the 2 lawyers that I knew that actually dealt with the Levine case directly and said, what went on, what happened, where is this, and what's the future of it? But the same technique that I used as a protection against bankruptcy, call it an asset protection play, is the same technique that is used by some people today as a way of discounting the value of people's estates. And I'm not going to go into all the different iterations of that technique, but there are lots of them. But that is a creative use of life insurance that you cannot use with anything else. As I described before, there are 3 types of basic insurance. There's whole life, there's term insurance, and there's universal life. Let me tell you the differences because I'm going to go into another product that's important and my time is limited. In whole life, the insurance company invests your cash value in their general account. Same thing with universal life. The money is invested in their general account and subject to the creditors of the insurance company. In those arrangements, you care about the credit worthiness of the insurance company because if the insurance company goes bankrupt, your cash value goes bankrupt. The other product that insurance companies have is called variable life. Variable life is a universal life policy where the cash value is not invested in the insurance company's general account, but yet the cash value of your policy is set up in a segregated account, and for the most part, not subject to the creditors of the insurance company because it's held in this segregated account. Different states have different laws, but as a general point, it shouldn't be subject to the creditors of the insurance company. In a variable life policy, the insurance company is not investing in the general account. They're giving you a list of investments that you can choose from. You can choose the managers. So they're typically overpriced and underperforming mutual funds that are on their platform. It looks kind of like your 401k. You can go on there and click off different funds and go out and hopefully beat the rate of return that you would have gotten in the if you invested in the insurance company's general account. Take that to the next level, because wealthy people can do things that other people can't. In order to have sexier investments that are on that platform to invest in, as you know, better, sexier investments are typically only available to accredited investors. So the IRS said that if you want to do a variable policy that has credit funds and hedge funds and all sorts of interesting investments, you can only sell it as a private placement and sell it only to accredited investors. So we came up with a product called Private Placement Variable Life, which is only available to accredited investors. And the cost of those insurance contracts typically are significantly less. And the cash value choices are significantly more sophisticated and should have better rates of return over the long haul. There's two models of that. One is where you're buying funds off the insurance company's platform. And the other one is where we call the separate managed account, where the insurance company hires a manager and the manager goes out and builds a portfolio in these products. There are only two rules. One, the policy must meet a certain diversification on the last day of each quarter. And when they talk about diversification, they're not talking about the type of assets, they're talking about the number of assets. No one asset can make up more than 55%, two assets combined 70, three assets 84, 90. And that's reported to the insurance company on a quarterly basis along with the asset's value. But the next rule, which is the most important rule, which is not reported, is called the investor control doctrine. And I'm going to go very broad with this definition. The owner of the insurance policy, or anybody who created it or benefits from it, may not determine what is specifically bought and sold on a granular, regular basis in the insurance contract. There was a court case called Weber. Jeffrey Weber had 30,000 plus emails directing the managers to what to buy and sell on a granular, regular basis. 100% of those recommendations were acted on. And rightfully so, the tax court and the IRS held that the manager was nothing more than a straw man for Mr. Weber. And therefore, Mr. Weber really owned these assets for tax purposes, not the insurance contract. And you didn't get the tax-free buildup inside this insurance policy you thought you did. I've written extensively on this. If you have trouble sleeping, I'll be glad to send you my articles on it. But there are a lot of people that are trying to thread the needle on this because their egomaniacal, narcissistic, sociopath clients have to control everything. You cannot do that here. You will, the IRS does not want people controlling the assets of the policy. And there's all sorts of, look, there's very bright people out there that are always finding ways around things legitimately, but it's the sloppy ones that are going to get everybody else in trouble. These are great vehicles for ultra wealthy people to own as a life insurance policy. Why? Because rather than the crappy investments of the insurance company, maybe the hedge funds, the credit investments, and the guys over at Goldman Sachs and Bank of America could all out invest. So my money's growing entirely tax-free inside my policy, which is owned outside of my taxable estate. And then when the insured dies, all of the assets are paid to the beneficiary as death benefit, tax-free. In essence, your assets are growing tax-free during your lifetime and paid to the beneficiary, to use the wrong term with the same result, a full step up in basis outside of my taxable estate. I've read lots of articles that said that, maybe in a grantor defective trust, when the grantor dies, you get a step up in basis on the assets held in it because I own the assets for tax purposes. We could argue that another time. But I know clearly that if I took the assets that are in my family trust and put them into a private placement variable life policy or a regular life policy, and they grow entirely tax-free during my lifetime, when the insured dies, all of those assets get washed out of the tax system and the death benefits are paid tax-free. That, when you start penciling out the numbers, getting a full step up in basis on assets held outside of a taxable estate is an incredibly powerful tool.
Ed,
I
I have
think
a
I'm out
question.
of time, but I can
One
keep
question.
on, my wife knows I can keep on going with this forever.
One question, Ed. What if the independent investment advisor in the insurance dedicated fund happens to make an investment in the insured's operating business?
If the insured or the grantor or the owner of the policy controls the stock in that company, the majority, and they make a decision to sell the company, and the shares that are held by the policy get swept up in that sale, you clearly violated the investor control rule.
Okay.
Very good. Nope, not working. Your microphone. There we go. All right. Well, Ed, this was absolutely fantastic. And it is very important that you come back and speak extensively on private placement life insurance. Then also we have a lot of questions that we can answer offline. And you have a lot of new friends, but I want to thank you sincerely because you really do have gone a couple of thousand hours of study, obviously, above and beyond what's normal in our industries. And I'm going to continue to learn from you, and we're going to make sure we do this one or two more times. Jerry, do you have any parting words for Ed?
No, but the point is, when Ed does the private placement life insurance, it is a volatile investment portfolio, and Ed's going to basically talk about how to manage your investments in your private placement policy without violating investor control.
Yeah, that'll be the next lecture we do on sophisticated uses of private placement insurance.
Perfect. So Ed, you're coming back September 30. We were going to talk about other planning techniques, but you want to go ahead and do part 2 of this September 30, and then we'll push off the other planning techniques, or whatever your pleasure is. Maybe we could do the second hour September 30 on PPLI. Let's do that.
Okay, maybe we could do that.
All right. Well, Ed, I know you have plenty to do today. You're welcome to stay. You're welcome to go, whatever you decide when you decide it.
Well, I don't know what all these accountants on this call are doing, but I got to do my taxes.
Okay. Well, isn't there an H&R Block right near you?
Yeah.
Right near? So you have to do it yourself?
I think the crate of K1s that came in this week bounced the guy from H&R Block.
All right. Well, thanks again. So Josh, I'm going to share screen here. And is is Jerry's star pupil on with us? Jerry's here, but what about his star pupil? She was going to join us. She's not here. Josh, what's your cell phone number? She can call 727-420-7568. Josh will answer my phone and guide her in. And I apologize if we didn't give her the right instructions. But Jerry, shall we begin? Never confirmed.
Very good. Okay. A lot of what Ed talked about on the stuff that actually works, it's very difficult to explain it in technical terms. Most tax lawyers that I run into, the only people who can really understand them can read without the vowels. How do you like that? Huh? And the key is really not what you know, but your ability to communicate it in an understandable manner. And you can describe all these techniques. You can describe intergenerational split dollar, and you get all the wonderful you get this wonderful discount and all that. But people like to see the financial impact of this. And and it also becomes very important to explain something in an understandable manner. And the easiest way to explain something to someone who is not technically sophisticated in all of the tax language we use is simple to follow numerical examples. And so what Alan has done is design a program which is very simple. Just basically put in all your assumptions and see what the tax savings will result from different assumptions. And the nice thing about it is you can change the assumptions that you make. Now, the most important point is for shifting wealth into irrevocable trusts that are not exposed to estate taxes, there's actually 4 separate factors that all contribute to the wealth shift. And you can describe all 4 factors separately, and it can make sense, but when you combine the use of all 4 of these factors in one transaction, it actually supercharges they all build upon each other and really increase the tax benefits. And so what Estate View is designed to do is help you communicate how all these factors work. So I'm going to basically just say, what are these 4 factors? And anytime you have a client, you start out with the 4 factors. The first factor is what we call valuation discounts. I have a portfolio of marketable securities worth $13 million, and I like to do some estate planning with it. So the first thing you do is you put that portfolio of marketable securities into a family limited liability company or a family partnership, take back a non-voting interest that has lack of control and lack of marketability, and you take into account these valuation discounts, and lo and behold, that 13 million has a limited partnership interest worth 10 million. So what can I do? I now, instead of doing a $13 million gift, I do a $10 million gift. Or instead of doing a $13 million installment sale to a grantor trust, I do a $10 million installment sale to a grantor trust. All is well and good. Oh, by the way, one thing that Ed mentioned is intergenerational split dollar. Let's suppose you loan $10 million to the trust to use to pay life insurance premiums. And that $10 million note receivable is in your gross estate. It's not due because the insured is still alive because the insured is a child. And you discount it from $10 million to $8 million. And all of a sudden, the IRS has to say, yes, it's a long-term note, and you get a $10 million note that's valued at $8 million in the gross estate, and lo and behold, you save the estate taxes on $2 million. What you also have to take into consideration is you just got an $8 million income tax basis in your estate for income tax purposes. So now you have a promissory note of $10 million with an $8 million basis, and when the note is paid off for $10 million in the future with a basis of $8 million, your estate has a $2 million gain to report. So if you're going to discount these split dollar receivables, you have to remember you've created a step down in basis, and therefore there's an income tax gain to be reported in the future. I just wanted to point that out. The second factor that we consider for wealth depletion is what we call financial leverage. I have a $1 million of cash. I want to lend the $1 million to my irrevocable trust, and I can lend it for $1 million and charge the AFR at 4%. So basically, the trust now has $1 million of cash. Its only cost is paying $40,000 of interest each year. The trust invests the $1 million. It makes $60,000. the trust pays $40,000 of interest, and the trust keeps the $20,000 spread. So the second factor that contributes to what we call wealth shifting is the financial leverage. The third factor is, let's suppose instead of lending $1 million to the trust, I sell the $1 million asset to the trust for a promissory note. So now all I have is a $1 million promissory note. The $1 million asset that the trust purchased increases in value, and when I die, it's now worth $3 million. Well, guess what? All I had was a $1 million promissory note. The trust has the asset, and therefore all of the appreciation and value is out of the estate. So the third factor is what we call the freeze, and that works very well. Then there's the fourth factor is the fact that it's an installment sale to a grantor trust or a gift to a grantor trust. And in that situation, guess what? Let's go back to our example of a $1 million loan at 4% interest, and the million is invested at $60,000. For income tax purposes, that loan doesn't exist. There's no interest income or no interest deduction in the report. And the trust basically has $60,000 of revenue, $40,000 of expenses by paying the interest to the grantor, and it keeps the $20,000. However, for income tax purposes, the grantor has to pay the income taxes on the $60,000. So in that situation, you're also depleting the grantor's other assets by the income taxes. So essentially, the $20,000 of profit that the trust earned isn't taxable. If it was a regular non-grantor trust, the trust would have $20,000 of profit and have to pay income taxes, say at 40% on that $20,000 or $8,000, and would net 12. But by having a grantor trust, the trust doesn't have to pay the income taxes on its financial profits. So those four factors all work to shift wealth. And now I'm going to turn it over to Alan, who's going to show you how all these four factors combined work to shift wealth in a way that supercharges the shifting of wealth transfer tax-free. Okay, Alan, all you.
Thanks, Jerry. That's a hard act to follow. And thanks to everybody who's hanging on here watching. So this is the primary initial screen that you will see on Estate View. And on the left-hand side where you see the arrow is the input of information, which I'll be showing you. In the middle is one of the logistical illustrations. And on the right-hand side, you can click on each of these buttons in order to see the different scenario that you can use. Across the top, you can save the scenario to your computer using the file. You can generate a letter to the client using the client generation section. You can...
Wait, Alan.
Yes.
I want to go back. In other words, one of the things is you always are going to write a planning letter to the client, okay? And they say, give me a proposal, give me a planning letter. And of course, if you have to draft it from scratch, it'll take 4, 5, or 6 hours. So how does Estate View reduce the time on the planning letter?
And the answer is that it prepares the letter for them.
Right. Alan, can I still hear you?
Yeah, sorry, I'm having sound problems.
Yeah. Right. Essentially, what Estate View does is you put in all the numbers, and let's say you just do an installment sale to a grantor trust. And what it does is it takes all of the illustration, it takes the illustration and automatically pastes all the answers on your illustration into a planning letter. So all of a sudden, you have the first draft of your planning letter done for you in about 10 minutes. That'll save you hours and hours of time.
Right, right. Sorry, I've had a little sound problem. So when you open the planning letter, which I just had the computer draft, it will give you the information about the client, and then it will give you each of the planning scenarios, where they would be without planning, where they are with a bypass trust, where they are with a qualified personal residence trust, where they are with annual gifting, etc. So we'll share that letter with everybody, Josh. We can send that to all the attendees. So
Do any of the commercial software that do the numerical illustrations have this aspect?
not to my knowledge, I haven't seen it anywhere else. That's why we're so excited to offer it to the profession, because it really makes everything more interesting and also helps us to, as you say, communicate. So there's also a help button, and there's a calculation button. So just to show you, when you click on the calculation button, we have at this point 8 calculators: one for the qualified personal residence trust, one for the GRAT, one for the SKIN, one for the private annuity, one for a charitable lead annuity trust, one for the charitable annuity trust, one for the charitable remainder unitrust, which is brand new and not quite completely done, and then one that will provide you with an extensive spreadsheet for installment sales. But going back to the primary mode here, in the middle, you can see at the top Peter and Mary Jones, and you can see that Peter and Mary Jones have a $3 million residence. They have a 30 million of investments. Their house is going to grow at 4.7%. They're saving 150,000 a year right now, in addition to their investment rate of return. So one of them probably has a job and is spending some money, but still saving that. The growth rate in their investments will be 7.23% minus 4%, a 0.4% in investment costs and 2% a year in the value of income tax. And then there's $1 million policy on Peter. And if they die today, I click on the top right-hand side, and I'll have to turn off my cursor here. So click on the top right-hand side, current planning. No, they both die this year. The estate tax is going to be $3.5 million. Their descendants are going to have $3.2 million. But when I click to no planning 19 years, and I've assumed here that Mary will die in year 11. I'm sorry, Peter will die in year 11, and then Mary will die in year 19. You see these assets are growing, and you see the estate tax of 27 million. Now, the inputs on the left-hand side are easy to use. You've got a name, you've got a date of birth, you've got an age, and you can toggle these up and down. And you'll see that when I toggle these things up and down, like the age on the left-hand side, all of the numbers change to the extent that they're impacted. So this is where I've said that he's going to earn $150,000 a year until age 86. They're going to be saving, and at age 86, I can say that they'll save $125 a year, or maybe they'll spend $25 a year more than their income. Spouse 2, the same situation. The computer tells me that somebody 64 years old, female, and a smoker, is actuarially expected to live to 2039, a little bit longer, 2042 if not a smoker. Easy for me just to move the date of death up and down. Now here, and this is important, when Peter dies, if he hasn't used his estate tax exemption fully, then Mary may have the opportunity to use his exemption. If she doesn't remarry and her next spouse dies before her, she can use portability. So here we're assuming that portability will apply with a $32 million estate tax, but when I click on that, where it doesn't apply, now it's a $35 million estate tax. The next question is the exemption going down from where it is going to be in 2026, that's January 1, 2026, will it go down by 50% as presently legislated, unless you get a president, a Senate, and the House of Representatives to decide otherwise? The exemption's going down to half in 2026. But if I want to show what happens if it doesn't go down to half, I can click there, and then you see a much smaller estate tax. My next input is the estate tax rate, which is 40%, but if you are in an estate tax state, you could add to the estate tax rate here. We're not going to actually follow that state law, but it would give you a good approximation. And then, as you know, the estate tax exemption goes up by chained CPI each year. We're assuming a 3.71 CPI increase. We are again showing the business and investments here on the left under green, and then they have their $3 million house. So I'll go back here to the right, and I will click on bypass trust. And when I click on bypass trust, now you see that estate tax went from 22 million to 17 million, and that bypass trust, also called a credit shelter trust, which can be funded on the first death, would be maximized at 19 million, and on the second death would be worth 32 million. And just for those of you who are studious, I can also go back to the left and say, what if I lose the portability allowance and I'm fully using the credit shelter trust? And the answer to that is that would not be a problem at all, because you've used it in the credit shelter trust. Now, the next thing I may illustrate is a qualified personal residence trust. So when I click on qualified personal residence trust, you see that they may put their $3 million home into a Cupert. If I go to the left-hand side underneath green, you can see that I'm illustrating one 7-year Cupert where the exemption used on a $3 million home with a 7-year Cupert for Peter would be $1,928,000. And if I click this up, you see right now 7 years, $1,928,000. If I click it up to 10 years, it uses less exemption. It uses $1,561,000. But when I click to 11 years, it uses no exemption, because if he dies before year 11, the Cupert fails, and we use none of his exemptions. So you can show the Cupert failed, or you can show the Cupert succeeded, and I can put on a second Cupert if I want to by just simply clicking the number of Cuperts to 2 Cuperts. And now I'm showing two Cuperts, which would be nice if they each want to put half of the home into the trust. And Jerry, I want you to notice now when I click on annual gifting on the right, the left-hand side lines up so that now I'm at the annual gifting mode on the left-hand side. And I'll go ahead and get my pointer pen back out. This is a little awkward because when my pointer pen's on, I can't click on the computer. But in any event, I am showing gifting trust with starting with only $1 of value. I'm showing, as Ed said, you have a number of people that you can gift for in a trust. That's the Crummey power. I'm showing that they have 3 children for the first 8 years. And then in year 9, they'll have twin grandchildren, and that will give them bigger gifting ability. And then I'm showing them that all their gifting that they're going to do for the children is going to go into the gift trust. If they're going to gift half cash directly to the children, half to the gift trust, then we can show there'll be less in the gift trust, but the same estate tax savings. And then we're also going to show that if they want, they could gift LLC interests, non-voting LLC interests, and take a 35% valuation discount. So I've clicked on annual gifting there, and now you see the gifting trust. After the first year, it has 102,000. After year 11, it's very valuable. It's at 2,149,000, and after year 22, it's at 6,984,000. So that's really, really nice. Now, Peter, for example, could gift to one gift trust every year that benefits Mary. So Mary could be the co-trustee or the trustee of half of that, and she could receive benefits from that trust if she ever needs them, which is called a SLAT. But we're showing one gifting trust there. So, yes.
Question. All right. In other words, if you just wanted to illustrate one technique, outright gifting, which is the simplest technique, you can do so. And now, here's the key. If you did all this outright gifting to a grantor trust, who pays the income taxes on the trust income?
Beautifully, the grantor. And our calculations here take that into account.
And what I'm saying is, do you also show the amount of wealth depleted by the grantor of the grantor's remaining assets by the income taxes?
Yes, yes, we are showing that.
Do any commercial programs do that?
Not to my knowledge. A lot of people have spreadsheets that do it, but nobody's doing it in this easy to show approach. So I'm going to go to the right-hand side, and here you see, before I click on discounted gifting, you see that gifting trust at about 9 million, the estate tax at 10,000,003. I click on discounted gifting, and now that gifting trust is at 10 million, and the estate tax is down to 9 million. So certainly that is a strategy that is a no-brainer. And honestly, it's difficult sometimes to get clients to make that annual gift. It may be easier if you just send them an assignment of LLC interest once a year, or you could do it every January, December. So in 2024, I could say, here's your January and December documents for December 31st, 2024, January 1st, 2025. Please sign the first one before New Year's is over, the second one on January 1st, send them back to me. And then I don't have to bother them again until December 31st, 2026. So that's a possible way of doing that.
Now,
So,
Alan,
yes.
let me ask you a question. All the assumptions that you made them. But when you get a client in your office and they don't have ADD, sorry. In other words, you get the client in the office and you're making certain assumptions, and the client says, your assumptions are too optimistic. I want you to use lower assumptions. So basically, by having a state view, you can work with the client, sit with the client, and the client can basically say, what happens if this? So you basically get the client involved in designing the structure, because you can basically change all the assumptions, and the client can say, I'm not going to get this rate of return, I'm going to get a lower rate of return or greater. So one of the most important things of a state view is it gets the client involved so they can better understand the volatility of all of these planning techniques that we use.
That's right. And then what I found to be, what we're finding to be very useful is we can prepare a 15-minute video explaining generally how this works and what numbers we came up with. And then I can click on share.
You're telling me that you can basically have a recording of all this that you went through and send it to the client?
Right, I can just open up my Zoom account, or I can open up my GoToWebinar account or my GoToMeeting account. I can click on record and I can say, hey, John and Mary, this is Alan, and here is your estate tax planning scenario that I ran for you. And then I can just explain it, and I can go through each of these slides and explain each step to them. And then after I've explained it, I can also show them that you can use these check marks to decide which of these strategies you want to use. Like you said, Jerry, maybe they don't want to do a Cupert. I could just click off Cupert, and now the Cupert does nothing. Maybe they don't want to do annual gifting. They just want to see discounted gifting. Whatever it is I decide to share with them. And then I can click share with client, and then it has assigned a code 022103. That's their secret code. I click share URL. I click copy to clipboard, and now I can simply open an email and say, John and Mary, I am sending you a video, watch the video, and then when you click on this link, it takes you to the software program, and you have a 14-day license to use the software program on your own to see what your own scenarios might be. And we're finding that bright laymen do enjoy doing this. It's, I find it to be a lot of fun, but for them, it's also their estate planning and their wealth protection. So let me go back to discounted gifting, and I can turn more of the calculators back on here. So we have the full view. And now you see under discounted in yellow, you've got the life insurance situation. It's taxable, but when I click on life insurance, it turns purple, because what I've done on the left-hand side is I have a policy here, $14,000 annual premium, $1 million death benefit on the husband's life, and then post-plan, the pre-planning is no life insurance trust, post-planning is a life insurance trust. Now, if I want to add a second to die policy, I just click the plus button, and then I click the number of years for premium. I click what the annual premium will be. I click on life insurance trust because I'm going to do a life insurance trust, and then I click on I click up to the death benefit, and then when I click on life insurance, it gets added. So that works well. Jerry, any questions up to that point? Oh, I've got a new feature that I want to show you. I'm quite excited about it. It's still not where it's going to be, but we now in the life insurance program have a click for estimates. So you may be in there with the client and say, I don't know, how much would the life insurance cost? Well, you can click on estimates and say, well, you're a male. If you're in standard health and you want a term policy and you happen to be, I'll slide to 64 years old, and you want a 20-year term, the annual premium, our guesstimate, very rough guesstimate, would be $14,000 a year. Oh, you want to know what 30 years would cost if you want a 30-year term? Okay, I'll move over to 30 here, and a 30-year term will be, I'll go right over there, would be about $19,000 a year, or you'll be able, to click on permanent and find out what a universal policy may cost. So at least you can give them an idea of what the life insurance may cost. So that's going to be, we're working on that. The coding's all done. We just don't have the instrument panel finished.
Where
on
did
that.
you get the information for that?
I asked a friend of mine for life insurance quotes every 5 years from age 30 to age 75. And then if you're between 70 and 75, the computer extrapolates that off of our master spreadsheet.
All right. So you have basically allowed people to look at the impact of life insurance without having to bring the insurance agent in for all the figures.
Right. Because what I want to do on the life insurance area is I want the client to leave my office knowing a minimum amount of life insurance that they should buy. You know, especially when they're not estate taxable, Jerry, we find that quite often families, and usually young families, are underinsured. So I want to say, you know, John, if you die, I'd like for Ingrid to have at least 5 million, because at 4% rate of return in spending, that would give her $200,000 a year. You've only got 2 million of insurance. I want you to buy 3 million. And then he goes, well, what would it cost? Because before I make the decision, I want to know what's it going to cost. And that's why I'll be able to go to the click for estimates button and immediately say, well, here's your age, and here's how much 30 years costs. Here's how much 20 years costs. Go see a life insurance agent of your choice, but tell them that you think you at least want 20-year term, 5 million, and that you want to make sure it's a good quality convertible term, or you may go for permanent. Here's how much it might cost. So at least they have an idea. And our office does not sell life insurance. We have no financial relationship with anyone who sells life insurance or investments, but we want to make it easier for the lawyer or the CPA or the trust officer to just give a quick look and a number within spitting distance with respect to this. So
in passing, Alan, how has using Estate View impacted on the efficiencies of your practice?
Well, in the old days, if we wanted to run these numbers, it would take, I would say, 5 to 7 hours on average to pull all the spreadsheets together, and then another 5 to 7 hours to write the letter to the client. And then you still didn't know exactly where you were, because it's like looking at 4 maps at the same time. With Estate View, it takes us anywhere from 20 minutes to 40 minutes to get a much better view of where we want to go with the client, and then another 10 minutes to 30 minutes to do a video and the letter that I showed you. So for some clients, we're spending an extra 3 or 4 hours and giving them a much better plan, and then spending more time doing QPERTs, doing life insurance trusts, because they better understand them. And sometimes we're spending more time because of Estate View, but we are delivering a much better education and a much better plan. I'm sorry that's a long-winded answer, but Jerry, the more important thing for me as an advisor is it lets me design the right plan. It lets me see how effective my plan is, and it lets me explain it. I wasn't able to do that before, and I'm no longer beholden to an advisor who may be with a major brokerage firm and have a fancy spreadsheet program that you might wait 5 to 7 weeks to get, and then it doesn't understand these techniques that we're talking about.
So what it has done, and this is very important, is it has basically may allow you to do more, allows you to do a much better product in less time, and it also is a way of custom designing, because if the thing is, there's all sorts of different techniques out there. Should the client do a grat? Should they do an outright gift? Should they do a private annuity? Should they do an installment sale? And what it allows the client you to do is design with the client which technique or combination of techniques is best suited for a particular client situation, and also show you that because of the burn, you have to still retain, either directly or indirectly, a certain amount of asset value to pay the income taxes. And it ties everything together in a nice way.
Right. So now let's talk about the installment sale. So we have an irrevocable trust that will be established, and we will put, as Jerry said, $13 million into an LLC, and we will take, let's say, a 30% valuation discount. So yes.
Put $13,333,333 in before discount.
Okay. 13,333,333.
Okay. Now take a 25% discount
25% discount.
of 13 million. You put 12 million in.
Oh, okay. Let me go again. Oops. All right. Wow.
Okay.
Around 10 million. I like that.
Okay. So now the key is you also really want to use even numbers. So so if you do a $10 million note at 4% interest, it's easy to say the interest rate is going to be 400,000 rather than taking 4% on 9.1 million. So also the key is it allows you to illustrate it using nice even numbers so people can follow the math.
Right. So again, to show the numbers, the rule of thumb in the industry, which is not a rule, and Jerry, certainly can discuss that, is you typically want to make sure that that trust has a net worth of about 10% of the sale amount. So we can lock this in at 10% by clicking here, and it tells me I need a $1 million seed capital gift. Again, we put 13,333,333 into an LLC. We sell the 99% non-voting member interest at a 25% discount for $10 million. The $10 million.
Well, wait, Alan, you see where you had the first year gift at 1 million?
Yep.
Put 1,333,333.
Yep.
Take a 25% discount.
Yep.
Okay, so now your seed gift is 1 million. Again, all the numbers are nice and even.
Right. So it tells me it tells me my AFR rate, 4%. It's a conventional note. It's not self-canceling. And
wait a minute, Alan. What's that little thing in blue that says look up AFR?
Click on that, and it tells me my AFR.
Oh, so right, you don't have to go separately and find it.
That's right. That's right. And it shows you this month's AFR and the prior two AFRs. And as you know, for a sale, you can take the lowest. So you could go with 3.94% if you finish it this week.
All right.
Yeah.
So what Estate View does is it provides you with a lot of information by clicking on various links that you would have to separately look up. So again, that makes it more time efficient.
Right. So I'm going to say also something else Estate View does, Jerry, is, a lot of times people put S corporations or business partnerships under these installment sales, and it's not only a 7% or 5% rate of return of the entity, but the entity throws off income. And that makes a huge difference in the numbers. So when I click this at say 250, it means that when they do the installment sale, their personal cash flow is going to go down by 250, and the installment sale trust is going to be receiving an additional 250, and that's going to be adjusted with inflation each year. So I'm going to go ahead, you see the numbers I have here. I'm going to go ahead and click on installment sale, and you're going to see the estate tax goes from 3,000,006 to 0. So that completely zeroes out this family's estate tax.
Alan, do you have a spreadsheet that shows you the impact from year to every year over the note term or something?
In a different module, I have that, but let's see, I can go to actual annual amounts, and then here I can go to the installment sale, intentionally defective grant or trust, and this shows me every year the seed capital gift, the purchase of assets, again, an annual guarantee fee, the annual growth, the interest rate paid. It doesn't, the next version will have a spreadsheet, but otherwise you have to go to a different module to run the spreadsheet. But this shows you exactly how the numbers are arrived at year by year. And you, of course, have the ability to do this with any of the boxes that you see in the another thing, by the way, while I'm showing you, is I can click on timeline. And what this is telling me is that I'm illustrating on the top right side of this timeline. So what I'm looking at is here, there's no estate tax. But if they die, if they both die before here, 2030, there will be a little estate tax. So while it seems like overkill to do that installment sale, you may really want to do a little bit more of the installment sale. So I can use that view for any of these things. Like here, this shows that without the installment sale, here's the portion of their assets that will go for estate tax. Or before life insurance, there's a little bit more in federal estate tax. I'm going to hit full fit there. And now I still want them to pay some estate tax, so I can show you the last portion of this, Jerry. So what I'm going to do is I'm going to turn off the installment sale calculator. And when I turn off the installment sale calculator here, I've got $4 million of estate tax, or 3,000,006 of estate tax. So now the question becomes, would they like to do some charity? So on the left-hand side, I can select either a charity, which could be a family charity or a family foundation, or your donor.
Wait, Alan, hold on.
Yes.
You basically showed me that I'm going to have an estate tax cost of 3.6 million, but I've also shifted 85 million to the children. And what if I said, you know, the children don't need any more, and I don't want to pay the estate taxes on $9 million? So why don't I leave that $9 million in my will to charity?
Right. So what would you like the charity to be called, Jerry? Jerry Hecht Foundation. Print that in. People like their name. And then I have 100% of the residue going to charity. And then you're going to watch here two things. The estate tax is going to go to 0, but what goes to the beneficiaries is going to be smaller. So I'll click on testamentary to charity. And now there's 0 estate tax. The 9 million excess estate goes to the charity where the children can control it. But they're down from 85 million to 79 million. See, for every dollar that goes to charity, the children lose $16 of their inheritance because you're at a 40% estate tax rate. So, when you think of, oh, just leave it to charity, there'll be no estate tax, the client is really not thinking, but wait a minute, my children will get less. So you
But
watch.
look at this way. Do the children, I've given the children 86 million or 79 million. The children don't, let the children have 79 million and I'll give 9 million to charity. In other words, it's a way of encouraging people with using the numbers to instill charitable giving when they die.
Right, right. But then they might say, well, how about if we go half to charity? Well, I can click this to 50%. And now you've got the estate tax at $1.8 million. Charity's getting $4.5 million. So at least, you can illustrate it and picture it. Now, Jerry, what we do a lot of is we provide that the trust, maybe if there's 3 children, each child's trustee after mom and dad die can decide, do I want it and I'll pay estate tax on my share, or do I want it to go to charity and my share will go down by whatever degree by using disclaimers? Or, Jerry, as I know you would say next, if we're going to give 100% to charity because we want to pay no estate tax, should we consider a charitable lead annuity trust? And Jerry, if I click on charitable lead annuity trust, now it asks me what percentage is going to the charitable lead annuity trust, and I can say 100%. And then it's going to say what percentage of the charitable lead annuity trust down on the left-hand side there is going to go to charity for a term of years, and what's going to be left for the descendants, and how long will the CLAT be? So Jerry, what would you typically illustrate here? We have a CLAT calculator where you can go to get the actual numbers, but just for the sake of illustration, what would you typically, what term of years would you typically use, and what percentage to charity would you typically?
Well, here's the key. This is what's interesting. You already got you got close to 80 million going to the kids. And so the key here is, will the children need more than $80 million? So you can basically, taking advantage of what we call a long-term CLAT, they don't need this money. So what you do is you say, let's have the CLAT be a term of 20 years or 25 years. Typically, the children's generation is 25 to 30 years younger than the senior generation. So what happens is you put that 9 million or whatever we're going to put into a CLAT that's going to be zeroed out. And then that means that every year the children can decide what charities get the annual annuity. And then the children will know that there'll be a real nice amount at the death of at 30 years from now that can pass outright to the children. And at with that size of an estate, the children really don't need it. So it's another way of encouraging very wealthy people to give to charity, and showing that the CLAT is nothing more than a financial leverage spread. So you're actually going to be better off as well.
Right.
And
so
you
Jerry,
can illustrate it with all the numbers.
Yeah. So Jerry, would you illustrate it at 70% going to charity or 60% going?
No, I would want them to give 100% to charity.
Okay, but for a CLAT.
Yeah. The 9 million that would otherwise be subject to estate tax, I would put it all into a 20-year CLAT.
Okay, but then what percentage of the CLAT would be left over for the descendants after the 20-year term? Maybe 40% left for the family?
It depends on the investment rate of return and the discount, the 75/20 rate.
Okay, so we can go to the CLAT calculator. So now I'm on the CLAT calculator, and I've got a grantor age 70, a 25-year term. I'm clicking up to 25, and then we could do a shark fin CLAT where, oh, see the shark fin go across the screen? All right. So we could say that this CLAT will pay charity $5,000 a year for 24 years. And then I'll fit full that. I'll show every other year. So every year for 24 years, the charity will get $5,000 out of $1 million. And then in year 25, the charity will get $28 million. And we have $1 million going into it. And the CLAT is automatically calibrated to qualify for 100% charitable deduction. So if this needs to be 8 million, because their residue was 8 million, I just click on the bottom left-hand side to 8 million. There I am. And then you see that at the end of the 25th year, if this grows at 7% a year, what's going to be left for the descendants is going to be 18 million. So no estate tax. Charity's getting, as you see here, about 24 million over the 24 years, and your family's going to get 18 million. And then here, if you do this CLAT during your lifetime, I mean, why wait until you die if you can do this CLAT during your lifetime and save income taxes? So you're saving not only estate taxes, but you're saving income taxes if you do it during your lifetime, because you're going to get a income tax deduction. And then you get a nice income tax savings here, $2,898,000. If you're in the 37% bracket, you will pay income tax over the next years, but even if you live the 25 years, your family comes out ahead. And then if you look at the present value of the darn thing, you've got a $9 million present value. So this is a a really nice way to illustrate a CLAT. So, but we can make it better. We can go to advanced here, and when we click advanced, you see there bottom left on yellow, I could put in discounted gifts. On purple, I can show what the time value of money assumption will be. And in gray, I can show what happens after the term of the CLAT. So I'll click on advanced.
Again, the whole point here is but the program forces you to address all the factors that you need to consider. And to be honest with you, you're never going to remember all the factors at once. But with the program, we give you the ability to, with all the different little clicks, to think about all the factors. So it becomes, once you learn how to use this, it allows you to basically say, should I do a lifetime CLAT or a death time CLAT? I mean, it gives you all the ability to run illustrations to help you decide what to do in these various transactions, or how to design the transactions.
Right. So if I put the 8 million in an LLC and I take a 10% discount for lack of marketability, lack of control, now I'm going to have a lot more left for my descendants. If I could take a 15% discount, then I'm going to have more left for my descendants. And then if I live past the CLAT term, and I'll hit fit full, and the grantor pays the income tax for a few years on the income of the CLAT after the charitable payments Then it even shows the further tax savings. Then I go to general explanation and I click on PowerPoint, for example. I could click on planner's checklist and get a checklist. I can click on general explanation, get an explanation. I will be able in the future to click on sample provisions for a CLAT that our law firm uses. And then here I can put Jerry Hesh CLAT and click on submit. And it has just prepared a PowerPoint. There's my PowerPoint. It explains Jerry Hesh
I
CLAT.
forgot.
Yep.
It also generates your PowerPoint presentation.
Yep.
I forgot about that.
Yep. It tells you whether you're using a shark fin or what rate of return you're using. It gives you the exact information on the CLAT. It gives you the spreadsheet that you were running, and it then gives you more information. So all of this needs to be further refined. None of it is exactly where I want it to be, but kudos to Kevin Gray, our programmer. He's working really hard every day. I'll just show you quickly the installment sale with income tax analysis module allows you to build out the spreadsheet for both the grantor and the irrevocable trust, so you can see the impact of the payment of the income tax on the trust income. It allows you to toggle off grantor trust status. Then
this is very important. This is very important. There's a point in time where the grantor is going to say, I've built up millions of dollars in the trust, and the income tax I'm paying on it is way too much, and I want to basically end grantor trust treatment. So what this does, see where it says what's left in the taxable estate in that one column? If you keep going down, you can see that the taxable estate gets reduced. Okay. So basically, it gives the grantor the ability to decide at what point in time in the future should we turn off grantor trust status, so I no longer have to pay the income taxes.
That's right. And then Jerry, real quick, because I know we're running out of time, I just want to show you the charitable remainder unit trust is up and running. It allows you to, it knows the 75/20 rate. It allows you to do the CRUT as a 20-year term CRUT, for example, which is very common, or a lifetime CRUT. It allows you to put in the grantor's aid.
Stop.
Yeah.
Let's go back. One of the problems that we always have if you're going to do a charitable remainder trust for life is, let's go back to the client age 70 at the beginning. Okay. All right, I forgot. All right. And the client is always going to say, what happens if I die during the term of the trust? Well, it ends, and whatever's left in the trust goes to charity. And the client says, wait a minute, I'm 70 years old, and if I do a lifetime CLAT, what happens if I die early? The charity gets everything. I say yes. So you have a table there called probability of survival to a specific year. What's the probability that someone aged 70 will live to 85, 15 years from now?
53%.
Right. And so basically, you see the probability of survival, like for the first 10 years, it's very, very significant. So this can put the client at ease that the probability of my dying during the earliest terms of the trust are not that great, and I'm willing to take that risk.
Right, exactly. Jerry, do you do more of these as 20-year CRUTs, or you do more of them as lifetime?
Well, interestingly, I like to maximize the unitrust percentage. And remember, the unitrust is not sensitive to the 75/20 rate. Okay, so it turns out the unitrust percentage is greater the older you are. And if you're 52 years old, the unitrust percentage is 11%. If you're under 52, the unit trust percentage goes down. So what I like to do is, because I like to maximize the unit trust percentage, for anybody under age 52, I do a 20-year CLAT, a 20-year CRUT, because I can use 11% as the unit trust percentage. If they're over 52, then I do lifetime, because the unit trust percentage can be greater than 11%. That's a factor that I use to decide. But also you have to remember that the tables are based on the 2010 census data of the U.S. population as a whole. So if you go to like for example, you change go back to age 70, please.
Okay.
All right. All right.
Yeah. Hold on. Age 20. 70. Okay.
All right.
Got it.
Now, it basically, you see where go to age 86 or 85, and you see that the probability of, what did you do?
I went to 85.
No, okay. So basically, the probability of someone age 70 surviving to 85 is 91%. That's wrong.
No, I'll go to age 70.
It's a lifetime CRUT, age 70. Don't do it. Now, basically, you see that at age 85, the probability they'll still be alive is 53%. Okay? That's based on the U.S. Census data from 2010 and the U.S. population as a whole. Those tables are now 13 years old, and our clients have better health. So effectively, what you can show is, very simplistically, that you go to your insurance company, and they will rate you, and they'll tell you someone age 70 in average health and your age will have not a 15-year life expectancy, but a 20-year life expectancy. So essentially, what we're doing here is that your charitable income tax deduction is based on the assumption you're going to die in 15 years. So they give you a charitable income tax deduction for the present value of the remainder interest based on the charity's going to get it in 15 years. But if your real life expectancy is 20 years, they are really overvaluing your charitable income tax deduction, because the charity's not going to get it in 15 years. The charity's going to get the trust principal in 20 years.
Right, right. So our next step on this, Jerry, besides a lot of cleanup, is we're going to have a flip NIMCROT. So the person puts
Don't even go there.
What's that?
Don't even go there now, Alan. Okay, we'll save that for later.
Yeah. Okay. So I want to show, we got a few people left on here. I just want to mention a couple.
Alan, I've been drinking a lot of water.
All right. You need to run, Jerry?
I'll stay. Go ahead.
Okay. I'm just. All right. So I just want to show you a new feature here. And that is, Jerry, when you go to the self-canceling installment note, I could do a self-canceling note here for a 70-year-old. I see that the interest rate would be 8.6%. And then when the person dies within the term, there's no estate tax. But even if they live the term, there's $280,000 of estate tax savings. On the other hand, now I can duplicate this. So now I'm doing a second one. You see everything looks the same across, but I can change one thing. And in this situation, I'll just change this to a conventional note. So now across the top, you see first a 15-year skin, then a 15-year conventional note, lower interest rate, and more estate tax savings if the person survives the term, but certainly less estate tax savings if they don't. And then we're putting in comparison programs as well. So Jerry, I think that shows the audience at least the major tenets of the program. I think it shows you what's new in the last week and a half. Kevin is continuing to just amaze us with the speed that he's going on, and it's pretty cool. He works most nights, and around 6 in the morning, he's going to bed and I'm waking up, and we talk about what he's done and where we're going. And it's been really a lot of fun putting this together.
Well, the most important thing is it allows you to really communicate in a time efficient manner what would have taken you many more hours to do. And it allows you to custom design it using the client to work on it with the client. I mean, this is what's going to happen. This is the only program right now that kind of ties all this stuff together.
Right, and it's free now as we continue to test it. You can just go to estateview.link, estateview.link. Then when you get there, tell it that your email address is test, that's small TEST, at test.com, and then tell it that your password is test, and then you can use it to your heart's delight. We just ask you that we ask that you let us know if there's any issues or questions or suggestions you have. We're hoping it'll be on the marketplace in January. I think we'll make it there, but we just keep adding neat stuff. Jerry, thank you so much for all of your support and assistance and leadership, not only with this program, but with the Notre Dame Tax Institute, with all of your writing, your lecturing, your nurturing of ex-students far and wide. Very much appreciated.
Well, thank you, Al. But I'm also grateful what you do for the profession and all these Saturday sessions. It's really nice.
Thank you so much. All right, everybody, have a fantastic rest of your weekend, and we will see you very soon.